Hello everyone, I am Rakshita S. MCom Final MPM Government First Grade College Karkala, presenting seminar on the topic of Double Taxation Avoidance Agreement. Double Taxation Avoidance Agreements. The Double Taxation Avoidance Agreement or DTAA is a tax treaty signed between India and other country or any two or multiple countries so that taxpayer can avoid paying double taxes on their income earned from the source country as well as the residence country. The Double Tax Avoidance Agreement is essentially a bilateral agreement entered into between two countries. The basic objective is to promote and foster economic trade and investment between two countries by avoiding double taxation. The Double Taxation Avoidance Agreement is a government level agreement where taxation in one country is recognized by the other country. Thus, tax paid in one country is taken into account for the tax liability in the other country. For example, under double taxation avoidance agreement between India and Germany, tax on interest is specified at 10%, whereas under Income Tax Act it is 20%. Hence, one can follow double taxation avoidance agreement and pay tax at 10%, which is lower rate. Further, if Income Tax Act itself does not levy any tax on some income, then tax treaty has no power to levy any tax on such income. So, double taxation avoidance agreement provides for the reduced tax payments. Step to claim the benefit from double taxation avoidance agreement. First step, check the double taxation avoidance agreement status between the countries. In the case of India and US, it is applicable since double taxation avoidance agreement is already in place. So, to give relief to the taxpayers, the government of US and India entered into double taxation avoidance agreement. Second step, submit the below document to avail double taxation avoidance clauses. So, to avail double taxation avoidance clauses, the following documents are need to be submitted. First one, double taxation avoidance agreement form. Tax residency certificate. Self-attested copy of PAN card, that is permanent account number. Any other documents that are relevant to specific case. Then, objectives of tax treaties. International double taxation has diverse effect on the trade and services and on movement of capital and people. So, there is a transfer of capital as well as labor and movement of goods and services between the countries. Taxation of the same income by two or more countries would constitute a prohibitive burden on the taxpayers. When there is tax applicability with two countries, the taxpayer may have to pay tax twice. The domestic law of most countries, including India, mitigate this difficulty by affording unilateral relief in respect of such doubly taxed income. Section 91 of the Income Tax Act. The Double Taxation Avoidance Agreement is a tax treaty signed between India and another country or any two or multiple countries so that taxpayer can avoid paying double taxes on their income earned from source country as well as residence country. At present, India has double tax avoidance treaty with more than 80 countries around the world, but as this is not A satisfactory solution in view of divergence in the rules for determining the sources of income in various countries. The tax treaties try to remove the tax obstacles that inhibit trade and services and movement of capital and person between countries concerned. It helps in improving the general investment climate. So, by avoiding the double taxation, one can promote the investment. Need for double taxation avoidance agreement. The need for double taxation avoidance agreement for double tax avoidance arises because of conflicting rules in two different countries regarding chargeability of income based on a receipt and accrual, residential status, etc. As there is no clear definition of income and taxability thereof, which is accepted internationally, the income may become liable to tax in two countries. In such a case, the two countries have an agreement of double tax avoidance, in which case the possibilities are the income is taxed only in one country instead of two countries. The income is exempt in both the countries. The income is taxed in both the countries, but the credit for the tax is paid in one country and given against the tax payable in the other country. So there will be tax paid in one country only. In India, the central government acting under section 90 of the Income Tax Act has been authorized to enter into double tax avoidance agreement, hereinafter referred to as tax treaties with other countries. So, the double tax avoidance agreement is a tax treaty signed between India and another country or any two or multiple countries, so the taxpayer can avoid paying double taxes on their income earned from the source country as well as the residence country. Role of tax treaties in international tax planning. The tax treaty plays the following role: facilitates investment and trade flow, preventing discrimination between the taxpayers. So, double taxation avoidance agreement helps to avoid discrimination between the taxpayers, adds the fiscal certainty to cross the border operations, prevents that international evasion and avoidance of tax, facilitates the collection of international taxes. It facilitates the collection of international taxes as there is a agreement between two or more countries, contributes to attainment of international developed goals. And the need for double taxation avoidance agreement arises out of imbalance in the collection of tax on global income of individuals. If a person aims to do business in the foreign country, he or she may end paying income taxes in both the cases, that is, country where the income is earned and the country where the individual holds his or her citizenship or residence. For instance, if you are moving to a different country from India while leaving income sources such as income from interest on deposits here, you will be charged interest in both India and the country of your current residence as per your consolidated global earning. Such a scenario can have you pay twice the tax over the same tax income. This is where the double taxation avoidance become useful for the taxpayers. Types of double taxation avoidance agreement. The double taxation avoidance agreement can be of two types: comprehensive, first one; second one, limited. Comprehensive double taxation avoidance agreement are those which cover almost all types of the incomes covered by any model convention. Many a time a treaty covers wealth tax, gift tax, surtax, etc. too. So, comprehensive double taxation avoidance agreement covers almost all type of incomes. Limited double taxation avoidance agreement are those which are limited to certain types of incomes only. So, it is limited to certain types of income. Example, double taxation avoidance agreement between India and Pakistan is limited to shipping and aircraft profits only. A double taxation avoidance agreement is a tax treaty signed between two or more countries. Double taxation avoidance agreement can either be comprehensive to cover all the sources of income or be limited to certain areas such as taxing of income from shipping, air transport, inheritance, etc. Next one, model of double taxation avoidance agreement. There are different models developed over a period of time based on which treaties are drafted and negotiated between two nations. These models assist the maintaining uniformity in format of tax treaties. These also serve as a checklist for ensuring the exhaustiveness or provisions to the two negotiating countries. So, for non-residents individuals to who are working in other countries, the double taxation avoidance agreement helps to avoid paying double taxes on income earning in both their countries of residence and India. There are 80 countries which India has this agreement with. So, let us see what are the models of double taxation avoidance agreement. OECD model, UN model, the US model, and Indian model are few of the such models. Of these, the first three are important, most prominent, and often used models. However, a final agreement could be a combination of different models. First one, OECD model, Organization of Economic Cooperation and Development model, double taxation convention on income and on capital issues. In 1977, 1992, and 1995, the OECD model is essentially a model treaty between two developed nations. This model advocates residence principle, that is to say, it lays emphasis on the right of state of residence to tax. So, OECD is a treaty between two developed nations only. UN model, United Nations model double taxation convention between developed and developing countries, 1980. So, UN model involves the taxation convention between the developed as well as the developing countries. The UN model gives more weight to the source principle as against the residence principle of OECD model. So, it gives weight to the source principle, that is the two countries involved. That may be a country of residence and the country in which the individual earns the income. As a correlative to the principle of taxation at source, the article of the model convention are predicted on the premise of the recognition by the source country that first one, taxation of income from foreign capital would take into account expenses allocated to earning of the income so that such income would be taxed on the net basis. That B, taxation would not be so high as to discourage investment, and that C, it would take into account the appropriateness of sharing the revenue with the countries providing the capital. In addition, the United Nations Model Convention embodies the ideas that it would appropriate for the residence country to extend a measure of relief from the double taxation through either the foreign tax credits or exemption as in the OECD Model Convention. There are a lot of benefits associated with double taxation avoidance agreement. For the taxpayers, the basic benefit includes not having to pay double taxes on the same income. Apart from this, lower withholding tax, that is TDS, tax credits and exemption from taxes are the benefits of double taxation avoidance agreement. Thank you.